Hello, this is Patrick Bartolotto. I wanted to continue our series on discussing the general idea of accounting and the value for a variety of individuals, including those who are not accountants. And the topic I want to cover right now is the general idea of cash and accrual accounting. So, in accounting, when we refer to accounting, we mean accrual accounting. The US GAAP rules, the IFRS rules, really, no matter what setting we're in, are going to follow the rules of accrual accounting. Right now, I'm not going to do a full dive into all those rules. That would take many days, if not weeks. But the general idea here is to just do a brief overview of what we mean when we say accrual accounting. So first, it's worth comparing to like a starting point. And I'd actually argue cash is a great starting point because it's probably something that we all do at one point and consider. And so it's a very useful perspective to be aware of and to consider how we build off and augment that with accrual accounting. So cash accounting is almost surely what you're using if you yourself have ever done like a personal budget or manage a checking account or something like that. And in a very straightforward manner, we only depict cash transactions. So for a company, much like ourselves, actually, though, the main inflows would be cash collections from customers. So as our customers pay us, when we actually receive that cash, we would recognize that as the inflow. And the outflow would be when we pay for our specific expenses. So basically, we'd have inflows and outflows, and we would track them. The challenge here, and this actually probably works really well. I want to be clear, like why should we start here? It probably works really well for most of us in our daily lives. We don't engage in that many transactions, and we can think about our inflows being our income, our wages and salary, our outflows being the payment for our expenses. So cash accounting should be acknowledged as just probably the thing that most people do. And I really couldn't in any way recommend getting more complex if we're just managing our own personal accounts. The issue, and what I have there with incomplete, really comes down to with respect to businesses or broader projects, not really with respect to individuals. The issue is that when we're trying to depict the actual performance of a business, the business conducted, is that unfortunately cash accounting is going to leave the vast majority of real business transactions out. And in general, our thought is that we prefer a complete set of information about a business over a alarmingly incomplete set. Now, cash transactions are important, but they would be only one portion of the major transactions that businesses are going to face. And by businesses, I really mean businesses of all sizes, right? But extending beyond just an individual or even a household. There's another issue, which we'll cover with more examples, but I want to just highlight here, which is that there are major timing issues between the business conducted and the cash flows, where you can have items that are going to be, part of your business, but because the cash flows doesn't, immediately occur exactly at that time, we would be not really representing the business being conducted because it didn't immediately correspond to a cash flow at that moment in time. And as I mentioned up front, kind of why we do this is it is very similar to managing a checking account. And I would recommend this really for most individuals. When you go through personal finance stuff or talk about budgeting, it is really just, thinking a little bit longer term, and maybe you're getting into the idea of like making decisions for the future, like a capital budget or something like that. But still is mostly the best thing to do is, manage your inflows and your outflows and think about those in conjunction, with the horizon of like a month or whatever else. It also, therefore, might be preserved by very simple businesses, or I probably should just put in their entities. If your total amount you're dealing with across a total year is a small amount, I don't know that going to the level of accrual accounting is worth it. But we're going to do that right now because companies do follow accrual accounting. So accrual accounting is the requirement under the rules in the United States, under the rules in I can't say all countries, but I'm going to assume the vast majority of countries that have some forms of capital markets and incorporation of companies. What does accrual accounting do? Which, again, I'm just really going to refer to here as accounting. It focuses on the business itself. So the primary driver is not just the inflow and outflow of cash. The primary driver, what causes a transaction to be recorded, is a business transaction. So it is this sheer obsession with understanding and reflecting the business being done. And this matters because we're going to depict all transactions. It will include those that do not involve cash directly, and I'll give some examples in a moment. And just to be clear, it also records cash transactions. So at just an informational level, what's just on its face one of the major benefits of accrual accounting. Well, to be clear, if accrual accounting ignored cash transactions, that's a pretty big weakness. But importantly, that's not a weakness, right? That's not a thing. Accrual accounting is not only all cash transactions, it is in additional transactions, the rest of the business transactions too. So really between the two, cash accounting is extremely important. Understanding, assessing, looking at managing your cash flows is extremely important. And the good news about accrual accounting is accrual accounting includes those two, right? So accrual accounting's advantage is just in an purely informational sense is completeness. Relative to accrual accounting, cash accounting is alarmingly incomplete, even as cash, the cash transactions are really important, but accrual accounting is the cash transactions and the rest of the business transactions. So from just an informational perspective, if you're assuming information is a good thing, which I certainly do, you'd want the complete system, not the massively incomplete system. Accrual accounting is the complete system if your goal is to understand the business being conducted, including the cash transactions. So what's the general roadmap we use here? Well, we're going to record revenue, and revenue is going to be earned when the goods or services are provided to the customer. And on the other side of that, so that matters because it means revenue doesn't have to be literally collected in order to be earned. We focus on the business event of providing goods and services, not just or exclusively the collection of cash. To be clear, we also record the collection of cash. Expenses are incurred, are recorded. Actually, that's a mistake there. Expenses are recorded when they are incurred or when resources are used up. So we're going to record the expenses even if we didn't pay them yet, or even if we paid them at a prior period or a later date or something like that. Again, the emphasis here is on completeness, and that's the major benefit. It also, and this is more involved, I'll cover this in the future, but in many ways, accrual accounting is going to solve the timing issues that cash accounting introduces, and it's going to let us focus on the business conducted there. All right. And the simple reason for that, I have a typo, I'll fix that. The managing a whole business is more complex than just managing a cash account, checking account. So it's just that, if businesses were simple, and maybe they are for your personal household, et cetera, use cash accounting. It's once you get into more involved stuff, which I'll show on the next page. And I don't mean super complex. I mean just the general idea of even if you're running your own business, you probably want to think a little bit about accrual accounting. So let's get into some of the specifics before we wrap this up. We mentioned the idea that revenue is earned, and we're going to record it when it's earned. If it's earned but not yet collected, we still record it. That's an important thing. And how do we do that? Well, this is actually going to give rise to an asset. So when I'm talking about revenues and expenses, those are going to be reflected on the income statement. But you really can't have accrual accounting unless you have multiple financial statements. And that's exactly what we have. We have three. We have the balance sheet, the income statement, statement of cash flows. And the benefit of accrual accounting is that it's not constricted to one. We have the ability to actually reflect the full business and across three financial statements. So if you have revenue that's earned and not yet collected, we still record that as revenue earned because we've provided the good or service. But we're not technically done. Like, we don't just stop there. We're going to have an asset, accounts receivable, we call it, to represent the future cash flows that we'll collect from the customers when they will pay us. So that asset, accounts receivable, represents a future expected cash collection from revenue that we, the company, provided, but the customer did not yet pay us for. So we, the company, have on our balance sheet the asset, accounts receivable. We'll cover more of these in the future. Here's the general idea. The other side of that is we could have revenue that's collected before it's earned, and that actually gives rise to a liability. So again, we have the revenue recognized on the income statement, but we also need a balance sheet to reflect the other side of this transaction. In this case, if the customer pays us, the company providing the good or service, and we, the company providing the good or service, have not yet done anything for our customer, we have a liability, or you could think about this as an obligation to do something for them. So we have their cash. We didn't take our action yet. That's what this is. And we're going to represent that with unearned revenue, a liability, reflecting that we have their money, but we still owe them the good or the service. All right. So the good or the service must be provided by us, the company, before the revenue is going to be earned in this case. All right, those are my two general ideas of representing accrual accounting through revenue, and both require the inclusion of something on the balance sheet to make sure everything works out. The expenses also on the income statement work in the same way. Expenses can be incurred but not yet paid. And what do we do there? Well, we have to represent that we've incurred the expense, but we haven't made good on it yet. We the company that incurred the expense, haven't paid for it yet. So that's going to give rise to a liability. And commonly, and the good news here is accountants aren't that creative, which makes this a little bit more straightforward, but it's still a bit of jargon to get comfortable with. Commonly, we're going to call these payables. So payables are just forms of liabilities. And a great example, two common examples that I'm using here are wages payable. Means our employees have worked for us. So we, the company, have incurred the expense. The employees have worked for us. We haven't paid our employees yet. That gives rise to the expense being recorded, wages and salaries expense, something like that. And we haven't paid them yet, so we have to recognize wages payable. Utilities payable works the same way. We, the company, have incurred our utilities expense. We've used the utilities during the month or the year, whatever, but we haven't paid our bill yet. Well, the point is that it wasn't that those expenses weren't incurred, that they were not there. We can pretend they're not there, which we would be implied with cash accounting. No, of course we incurred those expenses. We recognize the expense, and we're going to recognize a liability to reflect the fact that we've incurred the expense we haven't paid yet. We could call that liability. This is not a requirement, but a good way to start. Something like utilities payable. All right. Then we can also have expenses that are paid for in advance of being used. So prepaid rent and prepaid insurance are good examples here. When we use these up, we're going to recognize the expense. So let's take prepaid insurance. Say you have a year policy. You're going to prepay that before the year begins, before you start driving the car, living in the home, or whatever else. So if you pay it in advance, that's actually recognized as something like prepaid insurance, and that's an asset on our balance sheet. But then as we use up that prepaid insurance, we're going to actually be reducing the asset and recognizing an expense, something like insurance expense. So say our insurance was $1,200 for the year, and therefore $100 a month. I'm keeping my math easy here. Each month, we would decrease our prepaid insurance account, and we would recognize insurance expense for that $100 a month. We paid it all in advance, but we recognize the expense not when we paid it, but when we use it up. The same thing would work for prepaid rent. We pay it in advance, but we recognize the expense as we use it up, as we occupy the space. So there's a lot more here. Obviously, lots of examples and lots of conversations around items on the balance sheet and the income statement and the statement of cash flows and how they all work together. And we will absolutely get into that. I just want to cover the basic idea and repeat some main topics quickly right now. The goal of accrual accounting is to completely represent the business conducted. We do that by trying to look at transactions that the business is involved in, not just when it collects or pays cash. Even though we still include the collection or payment of cash, we don't stop there. To do that, we actually need a system where we have three financial statements: the income statement, the balance sheet, and the statement of cash flows. And we will continue to work on those to show how this all works. In addition, we'll continue to work on accounts that we'll see whether they're revenues or expenses or assets or liabilities that come about as a part of accrual accounting. So with that, I'm going to end this. One more down and 10,000 more to go. And hopefully this is going well for you.